Good afternoon, everybody. Eric Hendrickson here, Tradition Mortgage. Just giving you a quick update in light of the Federal Reserve cutting the Fed funds rate today by 50 basis points. I think it always creates a little bit of confusion and misconceptions out there as to how that directly relates to mortgages. So I think it's important that just to, number one, define exactly what is a Fed rate cut. It really pertains to the federal funds, which is basically controls the borrowing cost overnight between banks. So really it doesn't directly have an impact on what's going on with mortgage rates. It is tied to directly to a lot of the bank type business loans, prime rate loans, those types of mortgages that are held by banks. So really when it comes to home mortgages, where does the money come from for home mortgages? It's not really direct bank lending, it's way beyond that. It's trillions of dollars that comes from the bond market. So really it's the open trading in the bond market that impacts mortgage rates. And that open trading in the bond market, you have to understand, takes into account daily future expectations for mortgage rates. So the big drop you saw in mortgage rates over the last couple of weeks was really the overall bond market pricing in the reduction in the global economy. So it's really a lot of money moving into kind of a safe haven investment type of products such as treasury bonds and mortgage bonds. So really this Fed funds cut really is just already, it's just kind of exemplifying what's already been priced into the bond market and home mortgage rates. So really what we're seeing today from a mortgage standpoint is really minimal movement in interest rates. And then keep in mind that the reason the Fed is cutting this federal funds rate, it's to stimulate really business investment and spending, where if they're successful, that will continue to improve economies, which does put upward pressure on interest rates. So ultimately, it is reflective of a contracting economic environment, which is supportive of low rates. But again, what it's trying to accomplish is really pushing things forward and accelerating business and economic growth, which ultimately should lead to higher interest rates. So I guess the question is, how low will rates go? Should you lock in or not? Really, it's impossible to time the market. We're sitting at historical lows. You got to take a look at, can you make a material savings based on your current mortgage rate? If you're going to refinance or if you're buying, does it fit in your budget? Again, we can't time the lows. It's historically attractive. I think you got to just look at the current environment. Are you saving money, or does it make sense? And go with it if it does. Because again, there's a lot of temporary money in the bond market. Just seeking protection. As soon as the virus fears dissipate, or if there's containment news, I think you're going to see a snapback. The risk of rates going up, in my opinion, is going to be a lot greater than the potential reward of rates going materially lower from here. So anyways, just wanted to give you a quick update. Thanks again for your business and have a great day.